Welcome back to Investing Talk Podcast, and we wish you Happy New Year and a good 2026 ahead.
Today we're looking at Symbotic.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We are talking about a major structural player in the automation space.
Right.
When you look at Symbotic, you're not just looking at a robotics company. You're really looking at a high-growth warehouse automation platform. It's focused entirely on, AI-powered systems.
So they're building the whole ecosystem.
Exactly. The infrastructure for the future supply chain. They're fundamentally replacing manual labor with intelligent proprietary software and autonomous hardware.
That context is vital, especially when you look at the speed they're executing at. I mean, we saw incredibly strong top-line performance. Q4 of fiscal year 2025. Revenue hit, what, $618 million?
That's right. Beat expectations.
And more importantly, that capped a full fiscal year where revenue jumped 26% year over year. That's just growth at a massive scale.
It is. But here's where we need to apply a little perspective. That 26% YoY growth, while it's excellent, it actually follows an even steeper rise. It was 55% year over year in FY 2024.
And that's the question that jumps out, right? Is that slowdown a bad sign, or is it just, a natural moderation after these huge initial deployments?
Well, management argues it's the latter, and I think the evidence supports that. They're guiding Q1 of fiscal 2026 revenue to be between $610 and $630 million.
So still looking at 25 to 29% year-over-year growth.
Exactly. So the momentum is clearly still there. They're guiding adjusted EBITDA to a pretty healthy $49 to $53 million for the quarter as well.
So the story is we're still growing fast, just stabilizing after that initial surge. But what really locks in that optimism for an investor is, well, it has to be the backlog.
That's the real story. The backlog is just rock steady at an eye-watering $22.5 billion.
It's a huge number.
It is. I mean, think about what that actually represents. It's not just sales orders. It's multi-year, deeply integrated deployment commitments from the world's largest retailers. It basically locks out competition for years.
And that really does underpin the entire investment thesis. But what about the quality of that revenue? Are they just selling big one-time systems?
No, and that's the crucial part. The shift towards stable, recurring income is accelerating.
The SaaS-like element.
Right. In Q4, we saw software revenue, which is super high margin, grow 57% year over year. And then operations services, that grew 21% to almost $27 million.
Okay, so that really changes the narrative. It makes them a technology partner, not just a hardware vendor. So let's pivot. What's the moat here? What makes their tech so sticky that a client commits $22 billion to them?
The moat is extremely deep because it's not just one product. It's a fully integrated proprietary AI operating system.
And once that system is integrated with a customer's own warehouse management system, their WMS, then what happens?
High switching costs. Plain and simple. I mean, imagine trying to rip out and replace the entire brain of a massive live distribution center. It's functionally impossible without just shutting down.
So that technical integration is the lock on the door. But what about performance? Are these systems actually faster?
They are rewriting the metrics. We are not talking about slow factory robots. Their autonomous systems operate at speeds up to 20 plus miles per hour.
20 miles per hour.
And they achieve throughputs of 1,700 cases per hour per induction cell. For a retailer, that directly solves the labor shortage problem.
Right, fewer people needed.
And on top of that, from an infrastructure standpoint, their design achieves a massive 30 to 60% reduction in building footprint. So they're solving the efficiency problem and the expensive real estate problem.
That footprint reduction is a huge selling point, but they're not stopping there. What's this about the next generation storage technology?
That's right. This isn't just a small update. It's a redesign that gets them even more density, and critically, it cuts installation time.
How much faster?
They're claiming 50% faster installation times. This is huge because it lets them recognize revenue from that huge backlog much, much quicker. It's also expected to drive higher margin deployments.
Okay, let's pivot now to financial health. For a high-growth company like this, they need a rock-solid balance sheet.
And they have it. The company ended fiscal 2025 with over $1.2 billion in cash.
A fortress balance sheet.
It is. It comfortably exceeds their debt, gives them ample liquidity to fund everything they need to do.
But we have to tackle the thing that spooked the market recently, the dilution. They did a $550 million equity raise, and SoftBank sold 3.5 million shares.
It certainly caused a shockwave. The stock dropped pretty hard intraday, but the recovery tells a very different story.
It bounced back fast.
Very fast. It traded about 14% above SoftBank's sale price relatively quickly, which suggests the market digested the dilution and ultimately saw the capital raise as a positive thing for growth, not a loss of confidence.
And where's that $550 million going?
Not sitting idle. It's going into 3 specific areas. Scaling that next-gen storage we just talked about, expanding microfilament solutions, and crucially, driving their expansion into healthcare.
Okay, and on the financials, they're positive on an adjusted basis. Adjusted EBITDA was $49 million in Q4, but they still posted a GAAP net loss of $19 million.
Right, and that's the classic high-growth equation. The GAAP loss is mostly driven by non-cash stuff, mainly stock-based compensation to attract top AI talent. The fact that they are generating positive cash flow on an adjusted basis shows the underlying business model is sound.
Institutions seem happy to look past the GAAP loss for now.
And one more thing on that front. The SEC concluded its investigation back in August 2025 with no enforcement action. That removed a huge regulatory overhang that was definitely suppressing the stock price.
Okay, so with that cleared up, let's talk about the single biggest risk, the one that gets the sell calls, customer concentration.
That is the primary legitimate risk. I mean, while they support over 1,400 stores for major retailers like Target and Albertsons, the reliance on their anchor clients, particularly Walmart, is, well, it's significant.
So the diversification strategy becomes the single most important catalyst to watch.
Exactly. And this is why the Medline deal is a genuine game changer. It's a major healthcare distributor. This deal is their strategic entry into a whole new vertical.
And why does that matter more than just adding another retailer?
Because it proves the platform is transferable. Healthcare logistics is highly specialized, different regulations, different products. The fact their AI could pivot to solve Medline's problems validates the entire thesis that this could be a multi-industry solution. It directly counters that concentration risk.
So if you're watching this for the next 3 to 6 months, what's on the calendar?
2 big things. First, the Q1 2026 earnings, probably in February or March. Investors will be looking for clean execution on that $620 million revenue target and just any signs that the Medline rollout and next-gen storage adoption are accelerating.
And the second point.
The macro tailwinds. The shift to AI and automation isn't going away. It's driven by worsening labor shortages and the need for a resilient supply chain. This company is a fundamental beneficiary of that global trend.
And technically, the stock has shown massive strength. It's up, 255% year to date? And that V-shaped recovery after the dilution suggests heavy institutional accumulation.
It does. To kind of synthesize everything, the bullish case really rests on 3 pillars. That massive, visible $22.5 billion backlog, their proprietary AI moat, and that $1.2 billion in cash to fund expansion.
But it all comes down to execution.
It does. Success requires a clean rollout of the next-gen storage and continued rapid diversification. The thesis is really strongest for investors with a multi-year horizon, say 12 to 24 months, to let that Medline partnership and the margin expansion really show up in the numbers.
So a final thought for you to think about. Think about how much the supply chain relied on manual labor in 2019 versus today. If you believe the labor crisis in logistics is only getting worse, what valuation multiple should an AI platform solving that problem truly command? We'll be back next week, but in the meantime, make sure to subscribe, like, and comment to stay informed.